Let's get our fundamentals clear. First, let's understand what are financial instruments. Financial instrument is basically a contract which creates a financial asset for one party and financial liability or equity for the other party. Look at this example. I am selling goods on credit and I create a trade receivable. That is a financial asset. It is financial asset for me, and for the other party it is a financial liability because it creates a trade payable. Look at the other example. I am investing in the shares of a company. For me it's an investment, a financial asset, and for the other person, the company where I have invested, it is an equity, not the liability, but it is an equity. So if it creates financial asset for one person and financial liability or equity for the other person, then it is called as financial instruments, and for that the base is a contract. Now let's spend a little more time on understanding what are financial assets, financial liabilities, and equity instruments. Financial assets can be cash, it can be investment in equity instruments. Here the focus is the quality of the instrument should be equity. Then if you have contractual right to receive cash or any other asset, that is also financial asset. If you have contractual right to exchange your financial asset or financial liability on a potentially favorable terms, the focus is potentially favorable terms, favorable conditions, then that is also a financial asset. Then what are financial liabilities? These are all the contractual obligations where you have to either deliver cash or your financial asset, or as per the contractual obligation you have to exchange your financial asset or financial liability for a potentially unfavorable condition, then that is called as financial liability. Financial liabilities are also contracts which will be settled or may be settled by issuing own equity shares of the entity, and these can be non-derivative based or derivative based. In case of non-derivative, the entity is obliged to or may be obliged to deliver it by issuing variable number of shares. In case of derivative, entity will settle or may settle other than by exchange of fixed amount of cash or any other financial asset, and this will be for fixed number of entities own equity instruments. If it sounds too complicated, do not worry at all. I'm going to take you through multiple scenarios where you will get the clear picture. Look at this scenario 1. Here you have to pay some amount. Okay, as an entity you have to pay some amount, and you know what is the amount payable, and for this amount you are going to issue equity shares, and you know how many equity shares have to be issued as well. Then in that case it is an equity. It is an equity. It is not a financial liability. Look at scenario 2. Here you have some amount payable, but the final amount payable is variable. It will undergo changes because of various reasons, and for that equivalent amount you are going to issue shares, and how many shares have to be issued, that is also variable because that is also dependent on various factors like market price and all. Here both the amount payable and number of shares that have to be issued are variable in nature, then in that case we will call it as financial liability. Look at scenario 3. Here amount payable is variable, how many shares have to be issued, that is fixed. Okay, but amount payable is variable, that is dependent on various factors. In that case also we will call it as financial liability. And scenario 4, here amount payable is fixed, but the number of shares that have to be issued is variable. In that case also we will call it as financial liability. So here if you noticed, there are 4 scenarios. In first scenario only the amount payable is fixed and the number of shares to be issued is fixed. Only in that scenario we will call it as equity, and in all other scenarios we will call it as financial liability only. Let's take an example. Let's say I have loan. I'm going to settle the loan by issuing shares, and this is happening at the market price. So here the payable amount is fixed, but the number of shares that have to be issued is variable. It is dependent on market value. So one parameter is fixed, another parameter is variable. So we will call it as financial liability. Look at this. I'm going to restructure my existing loan with some extended tenor and as a result I'll be paying more in the future. So loan restructuring with extended tenor, here I'm exchanging the old liability with a new liability. So longer tenor, higher interest outflow. So this is an exchange of one financial liability with another financial liability, and it is potentially unfavorable terms for the entity. So we will classify it as financial liability. Another example, I bought a call option where the exercise price is 100 and market value as on balance sheet date is 120. This is basically in the money, meaning it is a financial asset for the holder and financial liability for the writer. Okay. Then let us also look into equity instruments. Equity instruments can be explained directly and indirectly. Directly means equity means having residuary interest in assets after deducting all liabilities. That is, you have to think at it from the event of liquidation. In the event of liquidation, I'll settle off all the liabilities of the entity, and eventually what is left over, that is available for the owners, and that is equity. This is direct way. Indirectly also we can explain equity. That is any obligation which is not a financial liability, that is equity. Let's take a quick test to understand all this in the next session.